Okay, so you're here because you want to get up to speed on some pretty complex topics, but you don't want to wade through tons of jargon,
Oh,
right?
exactly.
You want the key takeaways. You want to really understand what's going on, and that's what we do here on the Deep Dive.
Right.
Today, we are taking a deep dive into private credit,
Right.
which is a huge and growing part of global finance.
Absolutely.
I think the number is somewhere between like 1.6 and 1.7 trillion dollars in assets.
Yeah. I mean, it's a big space. And it's growing really rapidly.
Yeah, a lot of people, have heard of private equity, they've heard of venture capital, but private credit maybe not so much.
Right, exactly. It's kind of the sleeping giant in some ways.
Yeah. And the resources that we've got for you today really offer a very comprehensive look at the whole space. We're going to be exploring how it developed, the different strategies that are out there, and how it might fit into, someone's thinking about their own investment portfolio.
Yeah, this should give you a really good kind of shortcut to understanding, the key elements of this pretty important part of the financial world.
Yeah, so we've got some great guides, some great resources that will kind of map out this territory, define the key terms, and explore some of the strategic angles as well. But first, I think we need to start with the basics. What is private credit?
So private credit at its core is really just loan financing provided by lenders who aren't banks.
Okay.
So it's not coming from your typical bank, and and the terms of those loans are privately negotiated.
Okay, so who are these non-bank lenders? You say it's not coming from Bank of America or Chase or Wells Fargo.
Right.
Who are these other players?
Yeah, so you can think of big private investment partnerships, so firms that are managing money for wealthy individuals and institutions. You've got pension funds who are trying to generate returns for their, future retirees. You have hedge funds that are, looking for a diverse range of investments. You have insurance companies who are managing their reserves. And then you even have sovereign wealth funds, which are representing national wealth in many cases. And what's interesting here is that these non-bank lenders aren't subject to the same federal banking regulations and reserve requirements that traditional banks are.
Right, so that's a key difference.
Yeah.
And so when these private lenders are lending money, I mean, what kind of security are they getting? Is it a handshake deal, or are there real assets involved?
Oh, no handshake deals. It's similar to traditional bank lending. Collateral plays a really big role. So it can range from a borrower's future earnings, the cash flow they're going to generate, their accounts receivable, the money that's owed to them, all the way to hard assets. So, buildings, infrastructure projects, equipment, and even things like patents or revenue from intellectual property.
Okay.
So, a range of different things can be used as collateral.
Okay, so if I'm a company, right, and I need to borrow money, why would I choose this private route versus going to a bank or going to the public markets and issuing bonds?
Yeah, that's a good question. There's actually a number of reasons. One is that for smaller businesses, for companies that maybe haven't built up a really long or pristine credit history, private credit can actually be a really good option.
Yeah.
And in some cases, it might be the only option.
Oh, interesting.
So, private lenders can often be a little more willing to work with borrowers that maybe don't fit that perfect mold of a traditional bank borrower.
Okay. Yeah, so more flexibility for certain types of borrowers.
All right.
What else is attractive about private credit to those borrowers?
Yeah, so speed and certainty are also really, really big advantages.
Okay.
So private credit deals can often be done, much more quickly than going through the, sometimes long and complex process of accessing the public markets.
Okay.
And then the terms of these loans can be much more customizable, much more tailored to the specific needs of the borrower.
Okay.
They can have these sort of direct one-on-one negotiations, which you just can't do when you're dealing with potentially hundreds or thousands of bondholders in the public market.
Right. Makes sense.
And then for some borrowers, confidentiality is also really important.
Oh, interesting.
And so, private credit deals can provide a lot more confidentiality because they don't have the same public disclosure requirements that you would have with a public bond offering.
Okay, so it sounds like it was really initially, kind of the realm of smaller players, but is that changing as the private credit market has grown?
Yeah, it really is. One of the things that's really fascinating here is that private credit is increasingly able to compete with traditional banks,
Hmm.
even when it comes to, lending to much larger corporations.
Okay.
So the amount of capital that some of these private credit funds now manage means that they have the firepower to really do some very substantial
Got
deals.
it. Got it. So it's not just, this niche product anymore.
Exactly. Yeah.
Okay, so let's talk about how this whole landscape has evolved. The resources that we've got mentioned the global financial crisis, the GFC.
Right.
How did that event kind of reshape this industry?
Yeah, the GFC was really a major turning point. So while private credit existed, before 2008, you know, it was mainly focused on, things like mezzanine financing and debt of distressed companies. But the whole picture changed, quite dramatically after the crisis.
Okay.
The stricter banking regulations that were introduced, in response to the crisis, led traditional banks to become much more cautious.
Yep.
And they started to pull back from certain types of corporate lending. So, you can kind of think of it as the tighter leash that was put on banks, after 2008, essentially opened up this whole new playing field for non-bank lenders, who could operate with more agility, and with less sort of bureaucratic baggage, in many cases.
Right. Yeah,
Okay.
because they don't have all those regulations.
Exactly. Yeah. And that's really one of the, the fundamental reasons why we've seen such, really explosive growth in private credit.
So in a way, those regulations kind of unintentionally fueled, this growth of private credit.
Yeah, you could definitely argue that that's the case. Our resources highlight, the really significant surge in capital raised since, around 2015.
Hmm.
And it kind of peaked in 2021.
Okay.
And it's not just any, corner of private credit that's booming. Direct lending, where lenders are providing loans directly to companies without, any intermediaries.
Right.
That has become really the dominant strategy.
Okay.
Based on the amount of money raised each year.
Direct lending. Got it. And it's actually now a bigger slice of the pie in private markets than even real estate.
Yeah, that's exactly right.
Yeah.
So as of June 2023, private credit actually overtook real estate to become the second largest private markets asset class.
Wow.
Behind private equity. So that really just kind of underscores how large and how important it's become.
Wow. Okay. So it's a big deal. It's still growing.
Yeah.
Now let's shift to the investor's perspective for a minute.
Okay.
You mentioned earlier risk-adjusted returns. Why would somebody actually want to put their capital into private credit? What's the main appeal?
Yeah, so one of the primary draws is the potential for higher returns.
Okay.
Compared to, what you might expect from similar types of debt investments in the public markets.
Higher returns, always a good starting point, for investors.
Well,
what about the risk involved?
Yeah, so private credit has historically demonstrated lower volatility when you compare it to public equities.
Okay.
And it also offers the potential for what's known as alpha,
Okay.
which is essentially, outperforming a relevant benchmark.
Okay.
And that potential tends to be, greater in private credit than it is in public credit markets.
Okay.
And then there's also, the perception of potentially better downside protection as well.
Downside protection. How does that actually work in practice, for these investments?
Yeah, so there's a number of factors. Private credit loans often have, specific maturity dates.
Okay.
And many of them are secured by collateral, as we discussed earlier.
Right.
And they frequently hold a more senior position in a company's capital structure.
Okay.
Which means that, in the event of financial difficulties, they would typically be repaid before, those who are holding equity.
Okay.
So this combination of seniority and collateral can provide, a little bit of a safety net.
Got it.
And then also, they often have a shorter duration,
Okay.
compared to, private equity or venture capital.
Shorter duration meaning my investment isn't tied up as long.
Exactly.
Yeah.
And historically, private credit has actually outperformed public leveraged finance.
Okay.
Things like, broadly syndicated loans, high yield bonds.
Mm.
And because these loans aren't traded on public exchanges, their price fluctuations tend to be driven more by the the fundamental creditworthiness of the borrowers,
Okay.
and less so by the day-to-day kind of supply and demand pressures that you see in public markets.
Got it. Got it. So they're less susceptible to all the noise of the market.
Exactly. Yeah.
Okay.
And then our resources point to, potentially higher spreads as well.
Okay.
Anywhere from 200 to 600 basis points.
Okay.
Compared to public markets.
And just to remind people, 100 basis points is equal to 1%. So we're talking about a pretty significant potential return advantage.
Exactly. Yeah.
Okay.
And then, additionally, a lot of these loans have floating interest rates.
Okay.
Which can act as a hedge against rising interest rates.
Okay.
And many of them actually even include interest rate floors.
Okay.
So, your income doesn't drop below a certain level, even if, overall rates decline.
Oh, okay.
Yeah.
So that floating rate piece is definitely an attractive feature, especially in the current environment.
Absolutely.
Yeah. Anything else on the kind of the why invest side that we should cover?
Yeah. So the return of principal tends to be faster compared to something like private equity.
Yep.
The average life is around 3 to 4 years.
Okay.
And then the fund structures themselves often have shorter lives.
Okay.
Compared to other private investment strategies.
Got it.
And there's often a stronger alignment of interests between the investment managers, the general partners, and the investors, the limited partners,
Okay.
Compared to the sort of originate and distribute model that you see in the public markets.
Right.
Where the initial lender might, just turn around and sell off the loan.
Yeah, that's a great point. You want that alignment of interest as an investor. And the downside protection goes beyond just the assets that are being used as collateral, right?
Yeah, that's right.
So you mentioned that a lot of these deals include these things called financial maintenance covenants. What exactly are those?
Yeah, so these are essentially agreed upon financial targets.
Okay.
That if a borrower fails to meet those targets, it gives the lender kind of an early warning system.
Okay.
And an opportunity to step in and potentially work with the company to improve their situation.
Okay.
These can be things like, maintaining a certain level of debt relative to earnings.
Got it.
Or maintaining a certain level of cash flow.
Got it.
And then of course, as we mentioned, that first senior secured positioning,
right,
gives them that priority,
right,
in case of a restructuring.
Got it. And finally, it's worth remembering that private credit, provides access to a huge and really rapidly expanding part of the economy that's not traded publicly.
Right. Exactly.
So a whole, kind of different universe of potential investments. Now, within this broad world of private credit, there's different ways to invest.
Absolutely.
Different sub-strategies that cater to, different risk appetites and return expectations. What are the main ones?
Yeah. So our sources highlight 4 kind of key sub-strategies.
Okay.
And the largest one, as we briefly mentioned, is direct lending.
Direct lending. Okay, so that's kind of the heavyweight champion of private credit.
Exactly. Yeah.
What are the specifics of that strategy?
Yeah, so direct lending essentially involves, providing loans directly to companies.
Okay.
Without, going through traditional banking intermediaries or the public bond markets. And these loans are often used, for purposes like funding leveraged buyouts, mergers and acquisitions, supporting growth initiatives or refinancing existing debt.
Okay.
And interestingly, around 80% of direct lending activity actually involves companies that are backed by private equity sponsors.
Okay, so it's really kind of the private equity ecosystem where a lot of this is happening.
Exactly. Yeah.
And historically, these direct lenders, they were focused on a certain size of company, right? Like they weren't making loans to Apple or Google, right?
Right, exactly. Yeah. So the middle market was really the primary focus.
Yes.
And that's typically defined as companies with an EBITDA. That's earnings before interest, taxes, depreciation, and amortization of roughly $25 million to $100 million annually. But as the market has matured and grown, direct lending is increasingly extending to financing larger borrowers as well.
Okay.
And these loans are typically, senior in the company's capital structure.
Okay.
They carry floating interest rates that are tied to a benchmark like SOFR plus an additional spread.
Right.
And they can generate income through things like, prepayment penalties, if a borrower pays off the loan early.
Okay.
And an original issue discount, which is essentially interest that's built into the initial loan amount.
Okay.
And then, the funds that make these direct loans, they might also use a moderate amount of borrowing themselves at the fund level.
Okay.
Typically between a half a time and 2 times their own capital. So it's essentially like the fund itself is borrowing a bit of extra fuel.
Okay.
To potentially amplify returns, but it also, magnifies potential losses.
Right. Of course. Leverage is a double-edged sword. Okay. So direct lending makes sense. What's the second kind of major category within private credit?
Yeah. So the second category is asset-based lending.
Okay.
Which is sometimes also referred to as specialty finance.
Okay.
And in this strategy, loans are secured by, specific pools of financial assets or tangible, hard assets.
Okay. And what kind of assets are we talking about here?
Yeah, so you can think of things like, portfolios of consumer loans, auto loans, commercial real estate,
Okay.
equipment, so, like machinery or airplanes.
Okay.
And even less traditional assets like royalties, from music or intellectual property.
Okay.
And what's notable here is that the cash flow dynamic is a little bit different. So unlike direct lending, where a lot of the return might come, kind of at the end of the loan term, asset-based lending tends to have a more consistent stream of principal and interest payments over the life of the loan.
Okay.
And because the borrowers often have, ongoing financing needs related to these assets, these loans are frequently structured as revolving credit facilities.
Okay.
So kind of similar to a credit card.
Okay. So it's less about the overall financial health of the borrowing company.
Right.
It's more about the assets themselves.
Exactly. Yeah. It's really more about the value and the cash flow generation potential of the underlying assets, rather than just the overall, kind of creditworthiness of a corporate borrower.
Okay.
And returns are primarily driven by the yield.
Okay.
That's generated by these asset-backed loans.
Okay.
But there can also be additional upside from things like warrants.
Okay.
Which give the lender the option to buy equity in the borrowing company under certain conditions. And then similar to direct lending, these loans are usually floating rate.
Okay.
They're backed by diversified pools of assets.
Okay.
And they have specific covenants that are designed to protect the lender.
Got it. What's the third sub-strategy that we should know about?
So the third one is special situations.
Okay.
And this area generally involves higher levels of risk,
Okay.
but also the potential for higher returns.
Okay. High risk, high reward potential.
Exactly.
Yeah.
Yeah.
Well.
And it often entails, providing customized financing solutions, or acquiring assets at a discount.
Okay.
Because of, specific circumstances.
Okay. So it sounds a little bit more opportunistic.
Yeah.
And maybe a little bit more complex, right?
Yeah, that's a good way to put it.
Okay.
These lenders often require, highly specialized knowledge. Whether it's legal expertise for navigating, restructurings, deep asset management skills, for managing distressed assets, or just a thorough understanding of complex, financial situations.
Mm-hmm.
And they might target a whole range of different assets. So, anything from distressed real estate and non-performing loans to undervalued corporate bonds and loans.
Okay.
Some of the sub-strategies within special situations include things like, distressed distressed debt investing.
Okay.
So investing in the debt of companies that are facing, significant, financial challenges. Buying non-performing loans, at a discount to their face value.
Okay.
Or providing what are called capital solutions.
Okay.
Which are really just, tailored financing packages that are designed to address very specific needs of a borrower.
Got it.
And the loan structures in these situations, they're often very flexible.
Right.
Sometimes they include, features like payment in kind interest.
Okay.
So that's where the interest accrues and is added to the principal.
Okay.
Rather than being paid out in cash.
Got it.
Or even some form of equity upside for the lender if the borrower's situation improves.
Okay.
And then the returns they can come from both the yield on the debt.
Okay.
And potential capital appreciation, if the underlying assets, recover in value.
Okay, so that's where things get a little bit more, intricate and potentially more lucrative.
Exactly, yeah.
And what's the fourth category?
Yeah, so the fourth one is broadly termed, diversifying.
Diversifying.
And,
right.
and it's really kind of a catch-all for private credit strategies that don't neatly fit into the other three main buckets.
Okay, give me some concrete examples of what falls into this diversifying bucket.
Yeah. So you can think of things like investing in royalty streams.
Okay.
So for example, in the pharmaceutical industry or in the music business,
Right.
where a lender might provide upfront capital in exchange for a share of future royalty payments.
Okay. Interesting.
It could also involve providing regulatory capital relief to financial institutions.
Okay.
So these are specialized transactions that are designed to help banks meet their capital requirements.
Okay.
And then even investing in secondary transactions. So that's where you're buying existing stakes in private credit funds from other investors who might want to exit their investment early.
Okay, so it's kind of a little bit of everything else.
Yeah.
That doesn't quite fit elsewhere.
Exactly. Yeah.
Okay, so now let's circle back to direct lending for a minute.
Yeah.
And especially because one of the resources that we've got bills itself as a comprehensive guide to direct lending.
Right.
And it highlighted the $1.7 trillion market size, the increasing demand. What are some of the key takeaways from that more in-depth look at direct lending?
Yeah, so it really kind of reinforces that direct lending has become a really fundamental and mainstream method of corporate financing.
Okay.
The guide emphasizes the robust contractual protections that lenders can secure. The quicker timelines for issuing loans compared to the public markets.
Right.
And those direct one-on-one negotiations that we were discussing earlier.
Right.
And then it also points out that direct lending is becoming increasingly accessible to a wider range of investors through the development of newer and more flexible fund structures.
Okay. And the guide really stresses the significance of the U.S. middle market, right?
Yeah, absolutely.
So why is that segment such a key area for direct lending activity?
Yeah, so there's a few reasons. The guide suggests that lending to these mid-sized private companies can offer more attractive interest rate spreads.
Okay.
Generally lower levels of debt relative to earnings.
Okay.
And less intense competition compared to lending to the very largest, often publicly traded corporations. And then plus this middle market constitutes a really substantial portion of the overall U.S. economy.
Right.
It's a huge driver of growth and employment.
Yeah, it's not just the Apples and Googles of the world that are important.
Exactly.
Yeah.
And it wasn't always this way, right? The guide probably touched on this a little bit. The historical development of direct lending.
Yeah, they did.
So how did this all come about?
Yeah. So the guide explains how the consolidation of the banking industry and the increased regulatory burden that was placed on banks following the GFC,
Right.
led them to kind of reduce
Right.
their lending activities
Yeah.
to small and medium-sized enterprises.
Exactly. So they were pulling back.
Yeah.
And private credit funds kind of stepped into that void,
Yeah.
providing necessary capital to those borrowers and generating, consistent returns for their investors.
Okay.
And this trend isn't limited to the US.
Okay.
Europe and Asia are experiencing similar shifts.
Oh, interesting. So it's a global phenomenon.
Exactly. Okay.
Yeah. The guide also drew, some distinctions between, lending to companies that are backed by private equity sponsors versus, those that are not.
Right.
What are the kind of primary trade-offs there for lenders?
Yeah. So sponsor-backed deals, they can offer the advantage of scale.